Right, guys, it's currently the 4th of March, and on the 29th of March, which is in 25 days, the UK is supposed to leave the EU. So Brexit is supposed to happen. And right now it's kind of like a mess because they can't get a deal to get a soft Brexit, basically, right? So what that means is that on the 29th of March, if there's no deal, the UK could crash out of the European Union, and there could be disaster for the UK economy. Now, given that there's no deal, there are a few things that could happen. One of the things that could happen would be Brexit could be delayed, and or they may have a second referendum or a re-election in which it's possible that Brexit could be cancelled. Right? So no one knows what's going to happen. Now, before Brexit was announced about 2 years ago, you can see that the pound versus the dollar was about 1.5. And once Brexit was announced, people panicked. It dropped all the way down to 1.18. And since then, it's been ding-donging, and it's currently at 1.32. Okay. Now, in my personal opinion, I can't predict the future. I don't know what's going to happen. Okay. But at the same time, I believe that in a way, the market has priced in the worst case scenario, which is UK leaves without a deal, and hence we are where we are right now at about 1.3. Now, if it so happens that Brexit is cancelled or delayed, especially if it's cancelled through a second referendum, it's possible that the pound could go back to where it was, which is 1.5. So I'm willing to make a bet on that because I feel that again, the worst is priced in, and if it's not as bad as people think, which I don't think it's going to be, it could go back to 1.5. Again, I could be wrong. So whenever you think that you could be right but you could be wrong, how do you make a small bet so you've got limited risk but huge rewards? And the way I'm going to do it is by buying a call option. Now, I can't buy a call option on the pound dollar currency, the spot currency, so I have to use the futures market. So what I'm going to do over here is I'm going to look at the pound, Sterling Pound Futures, which is 6B. All right. So what I'm seeing here is the Sterling Pound Futures. And I can buy options on the futures. So you can see that recently there's been a bit of a change in trend where it's now on a small little uptrend over here. It looks like it's retracing down and it could continue the trend. Again, I'm betting that on the 29th of March, if it's delayed or cancelled with a second referendum, it could fly back to 1.5 or if not, at least 1.4. So I'm thinking of buying a call option that expires after the 29th of March. So I click on trade over here. Now you can see that options are expensive because of the uncertainty. Whenever uncertainty is high, options are expensive. So you can see that the current IV percentile for the pound futures is 53%. So normally we don't buy options when it's above 50%. But in this case, I'll still buy it because if the pound can fly to 1.5, it's still worth it, all right? Now, the concern when you buy options when volatility is high is the moment the volatility drops. After the event, you've got volatility crash. Remember, when volatility drops, the premium on the options drop. So that's the risk I'm taking. So in other words, after the 29th of March, when there's no more uncertainty and volatility drops, my call option premium could drop. I know that risk. At the same time, remember that when you buy an option, it's losing value and it expires worthless by expiry date if the price doesn't move. But I'm betting that, again, if there's a second referendum or Brexit is cancelled, the pound could move so strongly that the intrinsic value that I get from the call option will exceed the loss from the volatility crash, and I will basically profit before it decays, all right? Or rather, it will expire in the money, and that's the bet I'm making, okay? So I'm gonna buy the out of the money call options, all right? Because if it moves, it moves, okay? So what I'm gonna do is I'm gonna look at the option chain over here. So I'm selecting to buy Okay, so I'm selecting to buy the April call options that expire in 32 days. So that will be just nice because it will expire right after March 29, which means if it moves, it moves. If it doesn't, so be it, right? Now the question is, what is the strike price I'm going to choose? Currently, the price is 1.32. And again, I could buy in the money, at the money, out of the money. But because I'm making a bet on a strong move, and I don't want to spend too much money on it because I like to make a small bet, I'm going to buy out of the money options at 1.36. And again, there's no right or wrong. It's whatever you're comfortable with, right? So I'm going to choose a strike of 1.36. Now again, usually when I buy call options, I buy at the money or slightly in the money. But this is a unique situation because I expect a strong move if I'm right. So I'm willing to buy out of the money, so I buy cheaper. Okay, so I'm going to buy the 1.36 strikes. And the call options, again, you can see right now the ask price is 57 and the bid is 51. Okay, and the latest market price is 51 over here. All right, so I'm going to click buy a single call. Okay, so now let me start with just one contract. So one contract is going to cost me 0.0057. Now for pound futures, one contract would be equal to 62,500 pounds. So in other words, I have to take 0.0057 times 62,500 pounds. So that means the cost of buying the call is about $356. To confirm, I'm going to click this, send the order in to double check the order. There you can see. So you can see that the maximum loss, if I'm wrong and the calls expire worthless, I'm going to lose $356. Okay, but if I'm right and it goes up, what is my potential profit? It is infinite, right? The more it goes up, the more I make. Now let me just analyze the trade quickly over here. So I'm going to click analyze the trade. Okay, so you can see that this is the risk to return chart of the call which I'm buying. So you can see that above this is profit, below this is loss, and this is the call option. So basically what happens is, if the pound goes to 1.5, if it goes to 1.5, how much money do I make? Okay, again, I can click on this and look at the box over here. You can see I make $8,113. Let's round it to $8,000. So if I'm right, I'm going to make 8 grand. Okay, if it goes to 1.5. If it goes to 1.4, of course I don't make that much. I'll make $1,900. Okay, 1.9k. If it goes to 1.4. Okay, now if I'm wrong and Brexit isn't cancelled and we go ahead and it's a disaster and the pound collapses, you can see I've got limited risk. The most I can lose is I can only lose the premium which I've paid for the call. So the most I can lose is 355.95 or 356. That's my max loss. So these are the kind of trades where I bet $356 to make 2 to 8 grand. It's not a bad bet, right? So I'm going to take this bet and let's see what happens. All right, either lose $356 or I make 2 grand or 8 grand. And again, this per contract, one contract. If I buy 2 contracts, basically I'm risking $700 to make 16 grand. If I buy 10 contracts, I'm risking $3,000, make about 80 grand, right? So, but again, this is just for fun, I'm not gonna bet the farm on this, so I'm just gonna buy 2 contracts. All right, so you've got to trade, buy 2 contracts over here, and I'm gonna put a limit price of 0.0052. So I'll see if I get filled today. If I don't, I can always place it again tomorrow until I get filled. So confirming, I'm buying 2 contracts, so my max loss is 650. And if I'm right, I could make, again, 2 grand to 8 grand. Not a bad deal. Now, I'm also going to place a trade on Interactive Brokers because I've got, again, several accounts. And just to show you how I place a trade with my IB app. All right, so over here, this is one of the accounts I use to just demonstrate. And I'm going to first of all select the pound futures. All right, so I'm going to select pound futures. Go to pound. I'm going to select futures options over here. And I'm going to select the April expiry, call, and strike price 1.36. And I'm going to select this one, right, expiring on the 5th of April. Okay, so this is the one. You can see this is now the bid and the ask price. So what I'm going to do is I'm going to click buy over here. And I'm going to buy 1 contract. And the price, I can put the price at, well, I can put a limit order at 0044. Let's see if it gets filled. Because that was the last price. 0.0044. Okay, there we go. And I'm going to put it as a good to cancel order. So everything looks good, 0.0044. And I'm going to click the buy button. Okay, so the trade is in. Buying 1 contract of the pound call futures expiring April the 5th, and I'm buying at 0.0044, which means my risk will be about $350. If I'm wrong, I'll lose that. If I'm right, I could make up to 8 grand. So let's see how the trade goes. Once I get filled, I'll wait for the outcome and I'll report it to you guys.